very afraid that this will be the generation of dentists that sell out their entire industry. So my fear is that if we fast forward 10 years into the future, we'll be at a point where it's much more uncommon for dentists to own their practices.
All right, everyone, it's now time for the Ask Ken segment. We're super excited for the episode that we have coming up and our guest and the topics we're going to be tackling together. But first, the question that came in from a listener was, banks and investors seem to keep asking for accrual-based financials. Why isn't cash basis good enough, and how hard is it to switch? This is a great question. This is something that I think about a lot, and happy to answer this and hopefully point you in the right way. So the reason why they're doing this is because when you're cash basis, all that's doing is telling you what cash is coming in and out of your bank account. It actually isn't telling you what your actual performance is inside the business. It's not accurate. The more accurate we are, what that means is the more accurate we can do forecasting in the future, and we can figure out how we're going to grow our organization without running out of cash and just doing things the right way. Accrual matches up the revenue that's being completed. So think of patients and what is being completed with them. And we're recognizing revenue based on that. And then we recognize expenses based on what's called the matching principle, where we're lining up expenses with those revenues. So hopefully that has been helpful. If you have any other questions, please send them in. Happy to answer on a future episode. But now, super excited to introduce our guest today, Mike Baird, the CEO of Accelerate Dental. Mike, why don't you just take a second, tell us about who you are, and then we're going to jump right into what is the truth that you would like to bring forward into light today in the dental industry.
All right, Mike Baird, as you said, been in dental for about 6 years now. I used to be the CEO of Henry Schein One. I'm currently running a dental group called Accelerate Dental. We probably call it an anti-DSO group, and we'll talk through some of the principles, but the short story is we've got much greater ownership for dentists and actual real autonomy, and a very different model, as we're never intended to be sold. We firmly believe dentists should sell to dentists, and that dentists need to keep their ownership of practices.
Outstanding. Thank you for that initial overview, and I know we're going to unpack some of that today, but why don't you now frame up what this truth is that you feel like dentistry is perhaps sweeping under the rug or not bringing light to. We want to give you the floor now so you can talk about that, and we'll go back and forth on it.
Yeah, the truth I wanted to share is that I am very afraid that this will be the generation of dentists that sell out their entire industry. And, what do I mean by that? At a high level, if we look at other industries like medical, where some of these private equity consolidations have been the norm for, many decades at this point. Today in medical, it's roughly 80% of doctors are part of a corporate-owned group. It's very uncommon for the doctors to own their practice anymore. And when we look at the trends in dentistry, we see the same thing coming along. Different estimates put corporate ownership at roughly 25% or so of practices today. I think if you look at the trends in dental schools, roughly 60% of new graduates are joining DSOs, and specifically private equity-backed DSOs. And so my fear is that if we fast forward 10 years into the future, we'll be at a point where it's much more uncommon for dentists to own their practices.
So what is it then that entices these dentists coming out of school, looking for associate opportunities, or maybe they're looking for ownership opportunities? So what is it that's out there in the landscape that's causing them to make those decisions as opposed to going down an ownership route?
I think for the new grads, it's very understandable why they go down this path. I think dental school debt is higher than it's ever been before. They come out with multiple hundreds of $1,000s of debt. Ironically, because of all the interest in the space, it's driving up the price to go buy a practice on your own. You look at employment inside of a DSO as an example, and you see a more steady income, which means an easier way to pay off my loans, et cetera. And I think a lot of those things sound really good, especially if you're stressed about your debt. On the negative side, so if I were to say, well, why is this bad, Mike, if they sell out their industry? On the negative side, there's a cap to that. There is only so much that you're ever going to make because you only get paid on your production, number one. And number two, as the industry gets increasingly consolidated, there's no protection that ensures that production rates stay the same over time. What tends to happen, I always call this the Walmart effect, right? So whether we're talking about barbershops or chiropractors or car washes or HVAC companies or whatever it is, when there's consolidation of control, the goal is to lower those costs. Well, what's the biggest cost? It's labor costs. So just because a DSO might pay 30% of production a day, what's to say it's not 28% tomorrow or 25%, et cetera? And this is one of the challenges of when industries get consolidated. And the second part of that is I still believe that dentistry is a fantastic business profession for dentists to be in, and that it's not just about the production, it's about the profit that is created, which is over and above their production pay, that dentists doing smart things can actually increase that profit. And those profit distributions, which you never get long-term in a DS, are being given up on. And I think that's the sad part, is knowing that someone leaving dental school today, there's a fixed number of hours that you can work and get your direct pay, if that makes sense. And so, wonderful if you can work a lot and get $200,000 today, but if that $200,000 is the same pay rate that you're going to get for the next 30 years of your career, that's a little bit discouraging. And I view practice ownership and practice optimization as vehicles to profit that can enhance that dentist's long-term earnings ability. And I think it's really sad if they're giving up on that.
So you bring up obviously a myriad of really relevant points that they could be sort of looked at from several different angles. The angle that I want to talk about that I think will be the most helpful to our listeners is this concept of that associate. And when you look at what they're doing and what they're trying to accomplish in their lives and what their priorities are and those sorts of things, like, so why would an associate want to ultimately have ownership? What benefits and what drawbacks can exist from that, as they're going through this process? And like you're saying, hey, perhaps they could just be in dentistry for their entire lives and enjoy it and have a great lifestyle and everything that goes with that from a cash flow perspective, above and beyond what they're getting paid for the production that they're generating on a weekly, monthly basis. I'm interested how you would break that down.
Yeah, and then later we should talk about dentist owners as well, because it's not just the associate side, because it's actually the dentist owners who are the ones selling out the profession. But from associate, it is a risk versus reward approach, right? In the near term, I don't have the pain of operating an office. I don't have the work of trying to attract patients. In theory, the group that I work for, that's their job, and I just need to show up and see patients. And so in the near term, they're maximizing their earnings because the patients are there waiting for them, which is very nice. But the problem is then, it gets easy. Hey, I can make my steady income. I don't have a reason to leave and take the risk. So it's very true as an associate, if you leave straight from dental school and go start a new practice, you've got debt associated with that. You may or may not have patients that are coming in easily. You may have many years of pain as you build that practice. And so it's a little bit of like a straight line versus, a curved line. There will be a period where you are making less than you would have in that stable, secure job. Eventually you will pass that curve if you run the business correctly, and you'll make a lot more versus do you want a steady state? And there may be dentists where the steady state and less risk is the option. I'm not saying that's a bad choice for an associate, but I think a lot of them don't realize how much they're giving up on. And can people like you and I that have many, many, many dentists that we've talked to have the ability to see the difference and see how many dentists are way above that curve and have been able to have, fantastic earnings potential, fantastic impact on their clients, et cetera. And so I think a little bit of this is a risk and reward challenge. And at what stage do you take that risk and reward? Is it something that, because risk has risk, which means it doesn't have to have reward, but where there is more risk, there's greater reward. And I think the challenge for a new associate is, there's almost three options. Do I take the easy, the steady state option and stay there forever? Do I take a steady state for a while and then eventually transition to risk? Or do I take risk right from the beginning? And I think a lot of them think they're going to take that middle route. It gets increasingly hard as you make an income and your expenses tend to fill the income that you have, to now say, okay, I was making $200,000 a year. I was paying off my student loans. Well, now I'm going to stop and not make income for a while I build up a new practice. And so it's very, very tricky. Those are some of the things that I think are going through an associate's head.
Interesting. Thank you. That's a really, really helpful perspective. As you were talking, I was thinking about sort of these three options, and I realize there are derivations from each of them, but generally speaking, there's a tolerance of risk that has to be addressed here. And when you have somebody that's racked up 400, 500,000 of debt going to school to learn a craft that they really don't know coming straight out of school. They haven't learned how to be efficient and to, really hone their craft and become great clinicians. It takes time like anything else, but there's a risk tolerance to this, right? Where we might say, hey, I just want to start making money and start paying my debt off versus, hey, do I maybe want to try to start my own thing and become a business owner, which that is a whole different skill set and mindset that's required to take something like that on while you're also trying to be a provider and everything that goes with it. So I was thinking about these things as you were talking, and I think it'd be great. This is probably the right time for you to jump over and talk about now the ownership side of, the challenges, the benefits, the risk tolerances that are required if you're going to step into that level.
Yeah. And I think this is really where the action is, because today it's the dentists who are owners that are dictating where the future goes. They have a choice. Do they choose to go alone? Do they choose to join a DSO? Or do they choose to do something, some version in between? And I think that is where a lot of the interesting things come in. And I think there are trends impacting both the associate and the dentist, mainly in that as DSOs get more and more prevalent, and a lot of these are extremely large, multi-billion-dollar entities. There's a lot of marketing behind it. I mean, you might think if you were a dentist, student sitting in school right now that the only option was a DSO because that's who's coming on campus and paying for your pizza lunches to hear about what the future is. I think the same trends are also starting to hold true for dentists. They're getting a lot of marketing or industry insight or whatever it may be that sort of indicates, hey, this is really the only option. It's going to happen whether you like it or not. In fact, if you don't do it now, you might miss out on the wave. A lot of messaging that, this is how you're going to optimize your long-term earnings. And I think that's the part that I would challenge. I think the prevalent idea is increasingly becoming that as a dentist that in theory, I will make more money by selling my practice to a group, and hopefully if that group then sells to somebody else, I'm going to make some additional profit. The profit that I will make from that is greater than staying the course in my practice. And I think some of that is a little bit dependent on time. If you've only got 2 years left in your career and you want to maximize what you can sell your practice for, you might have one answer. I think it's very different if you are, a 35-year-old dentist and you still have 25 years of working. And I think often there's a misperception that the upside is much greater. And it's very difficult for a dentist who is an N of 1 to actually know what the data is. Oh, I'm going to go talk to 3 DSOs. I'm actually going to hear kind of the same story, and I'm just going to assume that's the truth. They don't have the visibility of, well, wait, I don't get to see what 1,000 other dentists chose to do and what their actual experiences are. And I think that's where people like you and I that talk with so many dentists actually get to see what does this actually look like in practice. And there's a couple of things that I think are data facts that I would share that are really important. Number one is when you're negotiating with a private equity firm, and whether they're the least sophisticated or the most sophisticated, and there are all types in this industry. But in every single one of those cases, I guarantee you the person on the other end of that transaction knows a whole lot more about finance and deal structure and value than the dentist does. Maybe there's an exception somewhere, but most of these dentists didn't go get MBAs and they haven't been investors for a long time. So rest assured that they are getting a deal that they know is better for them in the long term, or they wouldn't be doing that deal. Typically, what that looks like is something where you are trading a long-term stream of profits for some instant payment today in a very simplified version. And typically, the easy way I like to say this is, let's imagine you'll hear different multiples in the market. Suffice it to say, those are often overblown and exaggerated. But let's say that that's 5 times your profit. Well, that means I'm giving up however many years I'm going to work for 5 times my profit today. Well, Mike's corollary on this, my simple rule is, if you're going to work more than the years that you're getting in your multiple, this is a bad deal for you. So let's use it as an example. If you're going to work for 10 years of profit, and you're going to take 5 years of profit in payment, well, guess what? You're losing 5 additional years of profit that you would have gotten. So the investors know that, it's structured for that, or they wouldn't be doing this deal. Even for a dentist that wants to leave soon, they often think, wow, I'm going to get all this money today for my practice. What they don't realize is that's rarely a fixed number, meaning I think they think that going into this, I'm going to get, let's just say you make $1 million of profit and you're going to get $5 million in this buyout. They often think that that's, I'm going to get $5 million today and that's going to go in my pocket and I don't have to work anymore tomorrow. And I think often dentists don't realize that the way these deals are structured, there's two things that come into play. One is that there's usually a long-term contract. Well, you have to work at least 2 or 3 more years to make sure that profit doesn't change. And number two, if it changes at all, we're actually going to adjust what that 5 million was and you're not going to get it back. So there are a lot of things that I think dentists don't know when they go into this, and they assume, one, that they're getting a great deal, two, that their lives are going to instantly be easier. And they tend as individuals to anchor on the positive scenarios and not think about other factors like, well, what will it be like to have someone tell me what to do? What will it be like when they change my staff? What will it be like if there's different procedures? But those are all factors outside of the financials. I want to focus just on the financials, that generally speaking, for most dentists, if they have a robust practice with good profit and they're going to work any number of years beyond 5, which is the vast majority of dentists, by the way, most dentists are not within, 3 to 5 years of retirement. This isn't a good deal for them. And that's what I mean by selling out, because the other sad part about this is once you have then sold it, that equity is owned by a private equity firm. It will never again be owned by a dentist, ever again in the future. In theory, a dentist could come out of school and pay 20 times the profit to get it, but they'll want a profit on it. And it's just not a feasible number. And I think that's the part that is sad, is it's a holistic shift where once these practices eventually get bought up, it never goes back. And I think that's the part that we want to see changed.
Got it. Yeah, there's sort of a long-term trend that's occurring that if we stay on that path, the whole industry will basically be private equity or investor backed. So that's interesting. A couple things as you were talking there. The first one is, and I know that you mentioned it this way, but the doctor, when they sell and when they're exiting, I know so many who have done deals and sold, and then they sit on their hands for a year or two. They're bored to death, and they all are on a surge to come back and do it again, so to speak, because they have all these years left and the business that they now know is dentistry, and they want to maybe, come in and take a different angle, or maybe it's completely monetarily driven where they say, I'm going to go and build a group that one of these private equity groups will, pay a lot of money for, and so on and so forth. But I think that's an interesting piece of the puzzle. The other part is that when you kind of hinted on this, I want to put a pin in this part, and that is that most of the time when you sell to private equity, they require some of your equity to be held in that company moving forward. And they do that for a couple of reasons. A lot of times it's, hey, if we need help, or, you can't just bail on us or take people away and do different things like that, from the business. It's really fascinating to think about, how, and I've heard so many where they sell private equity and they roll, let's say, 40% of it into the holding company. And guess what? The new operators aren't running the business very well. They're actually running it into the ground. I know of a few of these where it's actually gone into receivership because it's been so poorly, the debt and everything has been managed so poorly. And their equity that is in that holding company is in jeopardy, and a few of them have already lost it. And I know of others that are in the process where they're probably going to lose that equity that they rolled up. So now all of a sudden, if you sell the business for $5 million, well, if they only gave you 2.5 in cash and the other 2.5 went into the holding company, all of a sudden that $5 million it just cuts right in half. What are your thoughts? And I'd love your perspective on that.
You nailed it. Unfortunately, none of us have the data from every single dentist. It would be amazing if somehow the ADA could go track the 20,000 dentists that have joined a DSO and what they were supposed to make and what they made. We don't know this. I can give you my observation, what I think those numbers look like. If I were to describe it, and you'll also hear other things. You mentioned the equity part. You'll hear things like, and you're going to trade part of this and that part is going to be worth 3 times more in just 3 years. Like, you're going to have this unbelievable return on it. And that's not to say that that's never happened, but it definitely doesn't always happen, right? If something sounds too good to be true, it actually is. My observation, if I were to guess on what these looks like, is about 10% of the time, the best case actually does happen. Somebody got, 3 times their money off of the sliver, usually the 10% they put in. So imagine my $1 million example of profit, I got $5 million. I put K of that. Usually it's limited how much you can roll, 10% in. I got a 3 times on that. I made 1.5 on that, plus a 4.5 on the rest of my business. Oh, great. I made some money. But again, that's still less than if I had kept working in my own business and kept it. I would say about 10% of the time you see something like that. The numbers are hard to get, but it's somewhere between a quarter and a half of DSOs that have gone into receivership. This is a staggering statistic. Again, very hard to get the actual numbers, but this is just based on the polling and folks that I've talked to. So just think about that. If you have any equity transfer and they go into receivership, it's immediately wiped out. The bank owns the group. And by the way, the bank then wants to sell it for the lowest price possible to some other owner who may do other things that you may or may not like. So
because the bank doesn't want to own it, and they know that they're not going to be good operators. In a few cases, they'll bring in a receiver, but most of the time, again, it's a very quick degradation down to almost zero.
They want to recover their costs as quickly as possible. So again, we don't know the exact numbers, but let's say it's 10% is really good. Somewhere between 25 and 50% is disaster. Because by the way, that's disaster. Because if you're still waiting to get your payments, and what you described, Ken, is a true statement. What if they're actually not good receivers and you actually don't have control? Almost every one of these deals will have a clause that says, yes, you're going to get it, but you have to maintain that same level of profit for the next 3 or 5 years that you're around working with us. And if not, we reserve the right to not pay you, which by the way, often means either they pull it back or they actually don't. They hold back some of that payment for a couple of years. So you're actually not getting $5 million on day one. You're, $2 million of that you get in year 3. And what if you don't have control over running it? And you're like, well, but you put a dumb person in front of my front office who scared my patients away. That's not our problem, right? So that's in those disaster scenarios. In between, you might have 30, 40% where it's somewhere in between those. Maybe they got some of the money, but it wasn't run as well. And then there's the other factors of I just didn't enjoy my life and it was frustrating. So hard to know exactly, but I think people assume 90% probable I'm going to be in the 10% scenario. And it doesn't work that way.
Yeah, we're always optimists until we're not, or we're forced to not be, right? The thing I was thinking about as you were talking there is when you go down that road, you are giving up control. And when you own your own practice, you have 100% control. Now, it's not easy having and running your own practice. It's not the easiest thing in the world. So doing your own thing and having full control, while beneficial, still some people will defer and say, you know what, I don't want that responsibility. I don't want to go down that road. So how would you advise them as they're thinking about like what would be the best solution for somebody like that knows that they don't want to do their own thing. They don't want to be a business owner with, no support around them to do that, but they do want to make a difference with patients and deliver great care. And they have some ideal around developing out the skill set to be a great clinician. What option
great
is
question
out there then?
Well, there's a couple of principles I'll lay out first, which is I think that clinical ownership of a clinic, but whatever form that is, doctors owning their practice is actually sacred. I think that doctors will always make decisions. They go to school because they want to serve people. It's not that they don't want to make money too, but almost every doctor I've ever met will make a trade-off between profit in favor of patient if needs be. And again, they still will do this in a way that makes them money over time, but I think they undersell what it may mean on some of those decisions. So, you've got a good family friend that comes in. They actually can't make their payment today, but they've been a great patient for many, many years. And so, I'm actually willing to extend them some credit because eventually it's going to come back. And they don't realize that may, if you were another group, that's not an option, right? And, you'd say, no, sorry, you must pay today and you must pay before. And if not, and maybe they lose that patient. I think doctors tend to make the right trade-offs. And so I just believe clinicians should own their practices and be the ones that are deciding where it goes, even if that means we make a trade-off. Another example would be, let's talk about supplies. A doctor may choose to use a bonding agent or a bracket or something that they believe lasts 10 or 20 years instead of one that lasts 2 or 3 years. Now, they do that because they take pride in their work and the quality, and they want that patient to tell their people, well, if you only look at this from a business perspective, you might say, yes, but if I save a little bit on that component, I actually can make a little more out of that procedure, and that's good. And if they have to come back in 3 or 4 years, it's almost like the tech companies that have planned obsolescence when your iPhone cable breaks and you got to buy a new one. I'm not saying that DSOs do this intentionally, but there's always that push and pull of where do you optimize on profit versus patient. So I'd lay that out as groundwork. I just think there's something about dentists owning their practices. And I think we've seen that in medical. As that ownership has shifted, it's actually been great for investors. They've made a ton of money in the medical industry through this consolidation. But by and large, costs have gone up. Patient quality of care has gone down. And I don't want to see that. That's when I say dentists are selling out their industry. When that changes, it's bad. Now, back to your question, I have empathy for a doctor when they want, the most important investment they've made in their entire life is their practice. This is like 80% of their net worth and their value. And so when they look towards a retirement someday or monetizing that asset, I can totally understand why they might think, well, look, this is my retirement. If I can get 20% more by selling to this group or this private equity firm versus selling it to another dentist, well, why wouldn't I do that? Can't I have a good retirement? And I agree with them. I think the problem is they don't realize why there's value in joining a DSO and that they have the option of creating that value as well. Let me give you an example. What that DSO is going to do is make the practice more robust if they do things right. They're going to make it more efficient. They're going to add more profit to it. In almost every case, they're going to try to make it a multi-doctor practice with additional ops. They're going to put staff around it so it's more productive. That's how they make their money long term. Well, there's nothing that says that the doctor can't do it. And so the doctor tends to assume scenario A, I go sell to another doctor. I sell my solo practice. I'm going to get 70% of collections for selling to that doctor. If I go sell to a DSO, I'm going to get, let's say it's 90 or 100% of collections. Well, that's a lot of money. I'm going to go sell to a DSO. What they don't think of is, well, why are you getting 70%? Well, if you're a solo doctor and you're selling to another practice, there is a significant amount of risk that when you leave, your patients leave, when you leave, your staff leaves. Well, now let's think about this for a second. What if you as a doctor can take that practice, add an associate, and actually make them a partner over time? Work with others to make it a more robust staff. Now, when someone's buying in, if this is a multi-doctor practice that's more efficient, has higher profit, you're actually going to get more than the 70%. It wasn't about who the buyer was. It's about what the practice is that changes the value. So if you take that as a principle, you say, well, you actually can sell your practice for more. Let's make it a better practice before you sell it. And the DSO is actually giving you a discounted rate on this in my 5 versus 10 year example, because they're going to do the work to improve your practice. If you're willing to do that work, you can still get that upside. And that's the difference between successful dentists and not. So then you asked, well, are there alternatives? And again, this isn't meant to be self-promoting, but I operate a group that is trying to be an alternative. There are other groups out there. So let's just talk group practice in general. Why do dentists go to group practices? We have more people around the table to help us manage the group. We can start to share resources across the group. If I have an accountant that manages the whole group versus one per site, I actually might lower my costs overall. And so I think there are alternatives where dentists can take advantage of some of the business insights and goals that could be done solo, investing in your own education, investing through smart consultants, investing in really good accountants. Not all accountants are great, who are going to help me move to accrual accounting instead of cash so I can be more strategic. Investing in an associate. Those are things that dentists can do on their own, and many successfully do it on their own. If they need help, they can look towards a group, or folks that can do it. I think the key for me is don't give up all of your equity or a majority of your equity, because then as those improvements are made, you miss out on it. But it's not that scale is bad. One of the analogies I always use, so again, dentists don't know what they don't know, right? They're an N of one. If you look at other industries, I'm going to use public accounting as industry. I think, Ken, both you and I were accounting grads once upon a time. In the accounting industry, they actually own their industry. So if you look at the 4 biggest players in accounting, PricewaterhouseCoopers, KPMG, Ernst & Young, Deloitte, these are firms that are not publicly traded. They're not on the stock market. They are not owned by private equity. They're owned by the accountants in a partnership model. That's just a group on steroids. And so what's beautiful is they've managed to do both. Get the elevation of having a larger group and having scale, so we can hire better marketers and we can hire, business consultants, and we can hire better accountants and grow. We can get better discounts on our supplies and do those same things without selling, right? They still are the owners perpetually, long term. And so I think there are options that we see from other industries. And I think group practices are an indicator of that. And we're actually trying to create a group that is that at scale, to be an alternative to the DSOs. But yeah, I think there are other ways to do there, but it really comes down to the practice, not the purchaser, that changes the value.
Right. One more question just around this. And I'm pretty sure you have strong opinion on this one. So I think this will be a good one. But the honest truth of building a business and then selling it is you end up getting this like lump sum of money. And then you say, okay, now I've got to kind of try to conserve this, and this is my retirement. And I've got to manage this and have this get me to the finish line. And maybe my kids will get lucky and I'll die early and they get a decent inheritance, right? The reality is that when you want to actually exit something, getting the lump sum is super messy, because what you care about is, do you have income coming in that can pay the bills, right? Most of the time, these transactions are just big one time, here's your lump sum, or here's, 40% of your lump sum, you'll get the other 60% when such and such happens, if it happens, and if it all works out okay. But I'm curious for your thought on this, because if somebody's really going to sell and they really are all the way done and they don't want to run a practice anymore, is there a methodology where they could actually monetize their practice to kick off the cash flow they need in retirement and still possibly own some or all of that asset?
Yeah, interesting question. And just to add on what you said, there's tax consequences, et cetera, right? Would I rather have a lump sum today where now it's a much bigger, income and a big tax burden, or is it better to kind of manage that over time and, a much longer term? And usually there's at least some discount for taking it all up front. I don't know. As a solo doctor, I think you would see this as, what if I were to hire 1 or 2 or 3 associates that replaced me, and I coach them and I manage them and I still kind of manage my business, but maybe I'm not fingers in mouth dentistry anymore, but they can maintain the practice and I get the profit. I think that's viable. Now, if you really don't want to do anything, at some point, someone's got to run the practice, right? And so the benefit you get is, for not having to work anymore, someone else gets the perks of that profit. So I think that has to be weighed out as an alternative. But I do think there are ways to at least start to shift that relationship, if that makes sense, over time. And I think associates are a key part of that. I know you talk a lot about accrual in a lot of your posts and podcasts. One of the things I like to talk about is the value of partnership and the value of covering your fixed assets. I think this is, I think a lot of dentists don't realize that their practice has very expensive fixed expenses in rent, in equipment, in labor staff that I'm paying regardless whether or not I work 2 days a week or 5 days a week. And the marginal profit that they get goes up dramatically if they can optimize that practice. And so part of what the beauty of bringing an associate, and I recognize that there are challenges with having another associate in your practice. I've got to get along with them. They may do work a little bit differently. They may work with the staff differently. But if you can learn to overcome them, as many people have successfully done, well, if it's the same equipment, and let's say I'm making a payment on that equipment. Let's say I pay $1,000 a month for this equipment and I do 1,000 procedures. Well, every one of those procedures has $1 of cost associated with paying off that equipment. Well, if I add another doctor that comes in and does another 1,000 procedures on the same equipment, well, now we're collectively each paying 50 cents, per that. I just created 50 cents of profit per every procedure that I do and that my associate does, right? So those are the kind of things that tend to create more value in the practice, Ken. And so it could be that the dentist stays and does it as an associate. It could be they bring in other associates. It may be that they work with consultants or partners or a larger group to help them manage those things. I just think that the trick is that there is a spectrum of options here, and too many dentists think it's all or none. Either I sit in my world as a solo dentist, and look, I'm not denying this can be a very challenging and hard and lonely profession, or easy street is that I go, to a DSO and all my woes will be washed away and I get all my money up front, and I'm sure they'll be very nice and give me all the autonomy. Again, we've shared some of the stats that may not be the case. There's a big spectrum in between there where you can pull on those levers of profit and how much I work versus how much autonomy I have versus how much ownership I have, et cetera.
That's a great answer. I think we're about running out of time here, Mike. This has been awesome. Love your perspective, love the energy, and thank you for being in the dental industry and being a voice here. I think what we want to do is give you just a minute to be able to share your contact information if anybody wants to reach out to you as a result of, listening to the podcast. So we'll give you a minute to do that and then we'll wrap up.
Appreciate it, Ken. Super fun to chat with you. Yeah, I think both of us care about the industry. And if I were to do a closing comment, it would just be, I hope that 10 years from now, it's not that the whole industry is owned. I hope that dentists continue their ownership, right? I think that's just such a great industry and such a great field. I tell my kids they should think about being dentists, and being owners. Yeah, we're happy to talk to anyone. As I said, I run Accelerate Dental. We're a group that tries to do a hybrid where the doctors keep that majority ownership and we don't ever sell this, and we have very low debt, so we don't fall into receivership, and doctors get that benefit of helping other doctors. You can contact me anytime. It's just mike@acceleratedental.com. We've got a website. I'm happy to talk to anyone and talk through, what you're trying to approach. But ultimately, just happy to be part of your podcast, happy to be in this industry, and happy to meet others that are trying to shape where it goes. I think there's a lot of potential options for the future of dentistry. And I hope we can keep that clinical involvement as high as it can be, because I think that's ultimately why dentistry is so great, is dentists love their patients.
So awesome. Great, Mike. It's been awesome to have you. So that's it for today's episode on the Dental Truth Project. Thanks again, Mike. Great insights. If you enjoyed the episode, be sure to follow or subscribe so you don't miss what's coming next. We drop an episode every Wednesday. I'm Ken Kaufman, and until next time, keep seeking the truth that will help dentistry thrive. Happy day.